The financial world just cracked, and most investors missed the real trigger this week. China implemented a strict export ban on silver on January 1st. This choked off 60% of global supply. Industrial giants like Tesla are already facing a devastating silver squeeze. Their margins are eroding fast. This isn't just a commodity story. It threatens the entire green energy transition. Simultaneously, a political war erupted in Washington. The U.S. Justice Department is now probing the Fed chair. President Trump then imposed a massive 25% tariff. This targets any country trading with Iran. Global finance is now shaking to its core. These events signal a profound systemic shift. But this shaking goes deeper. It reveals a fundamental battle for global financial control. Fed Chair Jerome Powell called the DOJ probe political intimidation. He made this dramatic statement in a Sunday video. It was a direct challenge to President Trump. Global markets braced for a sell America shock. The U.S. dollar index, or DXY, slipped 0.3%. International investors priced in a politicization discount. The 10-year Treasury yield climbed. This reflects a premium for potential loss of Fed autonomy. This week, top central bankers from 9 nations spoke out. They included leaders from the ECB and Bank of England. They affirmed full solidarity with Powell. They warned that central bank independence is critical. A politicized Fed damages its inflation-fighting credibility. It could force investors to demand higher rates. This impacts U.S. Treasuries worldwide. While the S&P 500 remained resilient at 6,961, other markets felt the tremor. Gold surged to $4.620 an ounce. It then retreated slightly to $4.580 by Tuesday. Industrial giants are getting hit hard. Tesla and solar panel makers face eroded margins. The cost of silver paste is soaring. This is a direct threat to the green energy transition. The financial sector is under immense pressure. Citigroup shares plummeted 4%. Capital One dropped 7%. Synchrony Financial fell 9%. This came after President Trump proposed a 10% cap on credit card interest rates. This could make subprime lending unprofitable. Banks are also navigating stricter capital rules. UBS, for instance, is battling Swiss proposals. These demand an extra $23 billion in capital. They warn of a 50% higher burden than rivals. This could weaken Switzerland's financial center. This isn't just about political squabbles. It is a fundamental reevaluation of risk. Investors are seeking safety in hard assets. They are moving away from traditional paper assets. This signals a shift toward a multipolar reserve system. Your portfolio needs to reflect this new reality. Welcome to Empire Finance. We cover economics, finance, and the latest news. Subscribe for daily, well-researched videos that go deeper than the headlines. Now, let's unpack the real battle unfolding behind these headlines. The fight for the Federal Reserve's independence is far more critical than you realize. This isn't just about political squabbling. It reveals a fundamental attack on the global financial system itself. The Justice Department probe into Fed Chair Powell is no minor inquiry. It is a criminal investigation. This targets Powell's testimony from June 2025. The focus is a massive $2.5 billion renovation of the Fed's Mariner S. Eccles building. Specifically, the probe centers on a $600 million cost overrun. It also examines the selection of contractors. This is a direct assault on the Fed's autonomy. Powell himself called these threats pretexts. He said they are designed to seize control of U.S. interest rate policy. This is happening just months before his term ends in May 2026. The administration aims to install a more compliant successor. National Economic Council Director Kevin Hassett is the rumored pick. This creates a dangerous deadlock. This situation has immediate financial consequences. It breaks a decades-old gentleman's agreement. This agreement protected the Fed from direct political interference. Economists now warn that a politicized Fed damages its credibility. Its ability to fight inflation is at risk. This could force investors to demand higher rates. This impacts U.S. Treasuries worldwide. The regulatory environment is also facing paralysis. Key initiatives like Basel III bank capital requirements are stalled. Climate risk disclosure frameworks are also on hold. This vacuum of leadership creates a wild west for financial institutions. Rules can change based on the latest political maneuver. We could even see a shadow Fed emerge. This would create extreme volatility in Treasury notes. Think about that impact on your bond portfolio. But here's the kicker. The global financial leadership is pushing back. Just days ago, central bankers from 9 nations issued a powerful statement. They declared full solidarity with Powell. This group included leaders from the European Central Bank and the Bank of England. They emphasized central bank independence. They called it a cornerstone of price and economic stability. The Bank for International Settlements also signed this statement. Their board chair and general manager joined in. The BIS is based in Basel, Switzerland. Notably, the Bank of Japan was absent from this critical declaration. This raises questions about global alignment. This is not just a U.S. issue. It is a global reevaluation of systemic risk. How are markets reacting to this unprecedented financial tension? While the S&P 500 managed a late-session recovery on Monday, finishing nearly flat at 6,961, this resilience is deceptive. Many traders are prioritizing robust corporate earnings and AI-driven productivity gains. They are looking past the constitutional crisis. But savvy investors see the deeper threat. The dollar's status as a stable reserve currency is now under threat. This drives a powerful flight into hard assets. Gold surged to an unprecedented $4.630 per ounce on Monday. Silver staged a parabolic run to $84 per ounce. These are specific, new record highs. Investment banks are taking notice. Goldman Sachs and JP Morgan are revising their year-end targets. Some now call for $5,000 gold by the fourth quarter of 2026. Mining companies are the clear winners in this environment. Newmont Corporation stock hit an all-time high of $106 this week. Barrick Gold has surged over 180% since early 2025. This isn't just a speculative bubble, it's a structural shift. Real assets are outperforming paper assets for the first time in decades. This fundamental reevaluation of risk demands your attention. Your portfolio needs to adapt to this new reality. But here's another seismic shift unfolding right now. While traditional finance grapples with old rules, smart money is quietly building bridges to a new era. A major global bank is now making a strategic move into digital assets. This isn't about speculation. It is about laying critical infrastructure. Standard Chartered, a massive international institution, is engineering a unique path. They are stepping into institutional crypto markets. They are doing this while sidestepping punitive capital rules. Basel III mandates a staggering 250% risk weighting. This applies to permissionless crypto assets like Bitcoin and Ether. This effectively blocks banks from holding crypto directly. It makes proprietary trading economically meaningless for them. Capital is the most expensive resource for banks. So how do they do it? They house their crypto initiatives within SC Ventures. This is their innovation and investment arm. This structural decision significantly reduces the capital burden. It gives them legal and operational flexibility. They don't need to hold crypto on their core balance sheet. Instead, they provide infrastructure for others to trade. This is like selling shovels instead of mining gold. Their revenue comes from stable, recurring fees. These include custody, financing, and trading fees. It offers superior capital efficiency. This aligns with shareholder and regulatory expectations. JP Morgan's Onyx and Goldman Sachs' dedicated desks use similar strategies. This is a quiet revolution in traditional finance. It legitimizes crypto at the infrastructure level. This move is a missing piece for institutional capital. Large financial institutions have interest in crypto. They cannot operate in fragmented markets. They need standards and robust infrastructure. Without prime brokerage, funds face operational nightmares. They juggle multiple exchanges and custody providers. This creates immense counterparty risk. Prime brokers solve this bottleneck. They aggregate liquidity. They enable large volume trades through a single access point. This reduces slippage. It standardizes operational processes. It provides real-time risk management and reporting. These are prerequisites for institutional investment. This explains why Standard Chartered's research team is making bold predictions. They see Ethereum potentially outperforming Bitcoin. They forecast Ethereum could reach $40,000 by the end of 2030. This isn't just a number. It reflects a belief in Ethereum's strengthening fundamentals. Its dominance in stablecoins and real-world assets is growing. Its decentralized finance ecosystem is expanding. Progress on increasing Layer 1 throughput by tenfold is critical. The potential passage of the U.S. Clarity Act could unlock further DeFi development. These are powerful catalysts. This institutional interest also highlights the underlying strength of supporting networks. Take Polygon, for example. Its network activity is soaring. This is driven by high-frequency prediction markets like Polymarket. These markets introduce transaction fees. They reward liquidity providers. They boost network engagement. Polygon recently achieved impressive throughput. It hit 16.67 million gas per second. Its revenue surged by 171% week over week. This shows growing adoption. It reveals stronger on-chain activity. It signals expanding ecosystem utility. These aren't isolated events. They are interconnected threads. They reveal a calculated shift in global finance. Banks are finding ways to participate in crypto. They are doing it without waiting for outdated regulations to catch up. They are building the rails for massive capital flows. This is a template for the future. You need to understand these underlying shifts. They will redefine your investment landscape. Adapt now, or get left behind. Now this brings us to the ultimate aha moment. While some institutions are finding clever ways to skirt new mandates, others are hitting a brick wall. This is the hidden truth about global finance right now. You won't hear about this on the nightly news. The world's banking system is fracturing over capital rules. Consider UBS, a global giant. They are fighting fiercely against proposed Swiss capital rules. These rules target how foreign subsidiaries are treated. UBS warns these proposals are extreme. They demand roughly 130% Tier 1 coverage for foreign units. This is far beyond the original 100% objective. It is a massive regulatory overreach. This isn't just a technicality, it has huge financial implications. UBS estimates these rules would demand an additional $39 billion in total capital. This includes Credit Suisse integration costs. This would also add $1.7 billion in annual capital costs. Think about that. These are staggering numbers for any bank. It would put UBS at a 50% disadvantage. Their capital requirements would be 50% higher than competitors. This applies to rivals in Europe and the US. The bank's CEO, Sergio Ermotti, is urging lawmakers to avoid these burdens. Switzerland already has one of the strictest capital regimes globally. They implemented the final Basel III rules early. Yet, these new Swiss proposals contrast sharply. Europe and the US are considering deregulation initiatives. This further weakens Switzerland's competitive position. UBS highlights a grim reality for shareholders. Regulatory uncertainty since April 2024 has led to a 27% share price underperformance. This equates to $30 billion in lost market value. This isn't just a UBS problem. It means higher borrowing costs for Swiss clients. It weakens the entire Swiss financial center. This threatens the economy. The Swiss Bankers Association also rejects this maximalist approach. They demand targeted regulation. It must align with international standards. This whole situation reveals a deeper truth. The Credit Suisse crisis wasn't just about capital. It stemmed from an unsustainable strategy. It involved inadequate risk management. And it had an inappropriate culture. Regulatory concessions undermined existing rules. This is a crucial lesson being ignored. But here's another critical piece of the puzzle. It ties directly to this regulatory chaos. While banks grapple with these capital requirements, a silent crisis is brewing. It is in the physical silver market. A major Swiss bank is reportedly short 2.1 billion ounces of silver. The global silver market is allegedly 20 billion ounces short. Let that sink in. UBS itself predicts silver could soon reach triple digits. This forces shorts to cover their positions. We saw Costco sell out of all silver in just 72 hours. This shows extreme physical demand. This is not normal market behavior. These are not isolated events. They are interconnected threads. The global banking system is under immense pressure. Some banks find loopholes. Others face punitive capital burdens. Meanwhile, physical asset markets signal deep trouble. Fiat currency itself is imploding. A shift to asset-backed currencies is underway. You need to understand these radical shifts. Your investments depend on it. Here's where the plot thickens for your finances. While some banks are fighting capital rules, others are preparing to capitalize on a shifting landscape. This week, the titans of American finance are stepping into the spotlight. JP Morgan and Goldman Sachs are leading the charge. They are revealing their Q4 2025 earnings. These reports are more than just numbers. They are a definitive litmus test for the U.S. banking sector's resilience. Investors are watching for key signals. They want to see if the Fed's rate cuts have stimulated corporate borrowing. They also want to know if these cuts are eroding net interest income. For JP Morgan, the focus is on stabilizing net interest income. This is after the Fed's 3 rate cuts in late 2025. The bank is also integrating the Apple Card credit portfolio. This acquisition requires a $2.2 billion provision for credit losses. That's a massive consumer finance expansion. It happens even as credit quality normalizes. JP Morgan also projects a massive $105 billion expenditure for 2026. Much of this is for AI and automation. This shows a strategic pivot. It aims for long-term efficiency. Goldman Sachs report will be a referendum on deal-making. Global M&A volume surged 42% in 2025. This means a significant profit lift from advisory fees. The market is looking for evidence. It wants to see if the IPO window is fully unlatched for 2026. These banks are signaling a return to growth. This highlights the opportunity cost of holding too much cash. And here's a critical insight for your portfolio. There are growing expectations. The Basel III endgame capital requirements may be significantly dialed back in 2026. This is huge. It could free up billions of dollars for banks. They could use it for share buybacks and increased dividends. This is a quiet shift. It could funnel massive capital back into the market. You won't hear this detail on mainstream news. Meanwhile, across the Atlantic, new regulatory shifts are underway. The UK's Financial Conduct Authority is actively shaping the crypto market. They are seeking feedback on proposals for a new framework. This aims to balance innovation with consumer protection. Key areas include rules for listing crypto assets. They also cover market abuse and trading platforms. Even staking, lending, and decentralized finance are under review. This signifies a push for transparency. It ensures investors understand risks without eliminating them. Furthermore, UK regulators are exploring bespoke market risk rules. These could apply to non-bank trading firms. This aims to reduce barriers. It could free up capital. This might attract new market participants. The existing rules were designed for banks. Non-bank firms have a different risk profile. This could boost liquidity and innovation. The Financial Services Compensation Scheme also faces changes. The FCA and PRA proposed a management expenses levy limit of £113 million for 2026-27. This is an increase of £4.4 million from the previous year. It covers the FSCS's operating costs. This reflects the evolving financial landscape. It impacts the stability of the entire system. What does this mean for your wallet? Big banks are pivoting. They are investing heavily in AI. They expect regulatory relief. New rules are coming for crypto. This is a dual narrative. It's about technological transformation and renewed confidence. You need to understand these undercurrents. They will create new winners and losers. Position yourself now. Don't be caught off guard. Your financial future depends on seeing these shifts early. And that brings us to this critical moment. The truth is out. The financial world is undergoing a seismic shift. Basel III endgame proposals still loom. UBS warns of $23 billion in extra capital. Meanwhile, gold surged to $4.630 an ounce. Silver hit $84. China's export ban just choked off 60% of global silver supply. Traditional finance is scrambling. Standard Chartered plans a crypto prime brokerage. Even the UK launched its first Bitcoin and gold ETP. The Fed's independence is under attack. These aren't isolated events. They reveal a global reset. Position your portfolio now for asset-backed stability. Don't let the mainstream narrative blind you. Subscribe to stay ahead. Comment your thoughts below.